Welcome to the Monocle Banking Podcast, curated by Monocle Solutions. Whether you're a financial professional, an enthusiast, or just interested in the political economy, you've come to the right place. Well, we're back after last week's technical nightmares, folks. All I can say is if you don't back up your data to the cloud regularly, do it now. Do it right after you've finished listening to this episode of the Monocle Banking Podcast. Now, this week we're heading into the African investment landscape, a place where not too long ago people used to look at the map and say, here be dragons mostly. The first great surge of foreign interest in Africa, which was dubbed the Scramble, was when 19th century European colonists carved up the continent and seized Africans' land. And the second was during the Cold War, when East and West vied for the allegiance of newly independent African states. The Soviet Union backed Marxist tyrants, while America propped up despots who claimed to believe in capitalism. And then we saw a third surge, certainly now underway, much more benign. Outsiders have noticed that the continent is important and becoming more so, not least because of its growing share of the global population. UN predictions that Africa will surpass China in the next couple of years from a population perspective, and governments and businesses from all around the world are rushing to strengthen diplomatic, strategic and commercial ties. And it all creates for a very interesting melting pot of investment opportunity. RMB has released its highly anticipated 2024 edition of its Where to Invest in Africa report, which has really become the comprehensive Bible of the top investment destinations on the continent. The report, which has been developed in collaboration with GIBS, the Gordon Institute of Business Science, leverages a really robust methodology that's been updated to reflect new data sources, also taking into account a variety of factors that have been proven to determine a country's progress and therefore its investment potential. And the results of the report show that the two small island economies of the Seychelles and Mauritius rank first and second as the most attractive investment destinations, while the significantly larger economies of Egypt, South Africa and Morocco rank in third, fourth and fifth place, respectively. Well, to unpack the report, I'm joined now by Sam Singh-Jami, who's a strategic analyst with RMB. I almost said strategy analyst, but you're a strategic analyst, Sam. Great to have you on the show. You conduct analysis for the various African countries that RMB covers, so this is really a big part of your baby, so to speak. Looking at your background firstly, and welcome to the podcast. You've had an interesting career so far. You hold a BCom degree in economics, business management and marketing from UKZN. You've got a postgrad diploma in business administration from WITS, as well as a capital markets and securities analyst certification from the CFA Institute. What led you into strategic research within the corporate investment banking world?
Thank you so much, Michael. Yes, so I have been doing mainly economic analysis, I would say, for the past 15 years or so. The strategy bit comes through when we look at strategy for some of our fixed income investors and looking where to invest or put their money. So bond investors and looking at the FX climate, looking at things like hedging as well. So it's been very interesting. And then I've also been tasked to do the way to invest in Africa. And I must say it's a little different to what I'm used to. I know the data very well, but I think the way we put things together forms quite an insightful publication.
Let's begin with that, because the research into where to invest in Africa has developed quite a corpus of knowledge. So perhaps you can share a little bit of background to the study itself and how it has evolved over the years into what we see today.
Okay, great. So Rand Merchant Bank started the Where to Invest in Africa in 2011. And I think there's been these changes throughout the years, but ultimately we've moved to something that has 4 pillars, from a model that had 2 pillars and a 6 indicator model to a model that has 20 indicators. So I'd say despite the 20 headline indicators, there's numerous data sets even within that. And sources of the data range from the IMF, World Bank, UNCTAD, individual country sources, as well as individual studies. So it's quite a robust methodology. And of course, data has become a lot easier since the start of the report. So we've tried to account as much relevant info as we could to help individuals and business make better investment decisions.
And that's what it boils down to at the end of the day, because Africa is not a country, it's a diverse continent of 54 countries. And I've had the great pleasure of traveling within a few of them over the last few years. It's amazing the energy one sees in Namibia, for example, with its recent oil and gas discoveries. And then you go over to, I was in Mombasa and Nairobi last year, a great deal of positive energy about William Ruto. But also, you see the challenges that these countries have from an infrastructure perspective, despite East Africa, and if you look at Kenya really being the digital poster child of things like M-Pesa, you land and then you travel by taxi on roads that are completely, we would call them undrivable in South Africa, but the local Kenyans just get by with it. Let's just kick off with what we see globally and how the global macro environment post-COVID is impacting on Africa, because we see these tensions between the US and China, and they say when the elephant fight, it's the grass that suffers, and it feels sometimes that way in Africa. How are we seeing these geopolitical tensions between the US and China specifically affecting African trade partners and foreign direct investment flows into Africa, given that I think both of those global superpowers now see some kind of strategic advantage in building deeper economic ties with Africa?
Yes, so I would argue that there's been shifts for some time in both trade and investment patterns and flows to Africa from both the US and China. If you look at FDI stock, both the US and China have something between $40 to $50 billion in Africa. But in terms of flow, I think over the past 2 decades or so, Chinese FDI has increased massively. And so that had overtaken the US. In recent years, I would say that most data sources indicate that the level of investment flow is roughly double of that of the US. In terms of trade, I would say that's similar. So provisional data for 2023 shows our biggest imports, so Africa, come from China, India, and then the US. And in terms of our exports, we do around maybe above $80 billion to China, and then closer to about $30 billion to the US. I think the other important aspect, apart from the trade and investment, is that, we shouldn't forget that China has also become a big creditor on the continent too. So the largest single creditor for some of these countries. That's been the growing dynamic for some time, but perhaps the geopolitical tensions between the US and China has generally scaled down their mutual trade, and other nations have seized or trying to seize the opportunity to boost their own exports. So not only to these countries, but then looking at it from a more global perspective.
And you touched on quite a few issues there. The one certainly that I think is in focus currently is Africa's debt dilemma and the very real concerns about sovereign default, given where global interest rates are. And if they remain higher for longer, that will only exacerbate the likelihood of debt default across the continent. What emerges from a debt perspective when you look at Africa's tendency to fuel and fund much of its growth through borrowing?
Yeah, so that's been a struggle. We speak about the infrastructure gap and how to bridge that gap in terms of financing. We've seen, Zambia and Ghana obviously being countries that have now had to restructure the debt and reach, various arrangements with both official and Euro creditors as well. So, it's been a difficult road for Africa in terms of financing. There hasn't been much market access of late, especially given, coming out of the COVID pandemic. But I think there's also been more innovative ways to look at financing for some of the infrastructure development. I think one should probably caution, countries when looking at infrastructure development to, prioritize projects. So Ghana and Zambia went full steam ahead with some of their development. And of course, you do need some of the revenues to be realized from some of these investments to help pay for things like debt servicing costs, but also to help enhance the economy as a whole. So yes, there's been a lot of struggles in terms of financing, potential risks around debt default, but I think we are coming out of the pandemic and some of the issues we had a little bit stronger.
So, given that, what would you say are the key lessons that could be drawn from the recent experiences of Zambia and Ghana with their debt restructuring? How can other African nations facing similar economic pressures prepare themselves?
I think firstly, countries would need to carefully manage and prioritize development spending, so slow and steady,
Yeah.
to make sure that components of the infrastructure spending are there, and you can see some of the realized revenue from these projects, and that can be used to service debt, but also beyond that to enhance the productive sectors of the economy. I think fiscal prudence is also important. Many countries have now had to rely on the IMF. Well, these programs are mainly homegrown, but I guess that's another conversation. But yes, countries have had to rely on the IMF to help be big brother and keep them in check.
And I know, following the global financial crisis, we saw the new regulations, Basel III, issued by the Bank of International Settlements, and they've come under a lot of critique. And one of the biggest was the fact that it inadvertently accelerated the withdrawal of international banks from Africa, which has only exacerbated the region's financial challenges because you've got the convoluted nature of the regulations coupled with their stringent capital requirements has made it increasingly difficult for international banks to operate profitably in African markets. And as a result, I think many of these banks have chosen to scale back their operations or exit altogether, leaving African economies with limited access to some essential financial services. Do you think Africa has been well served by global regulation that very often is written in developed markets and not really fit for purpose in more nuanced contexts in developing markets like Africa?
I would tend to agree with that. I think, African banks often face challenges. So, our limited financial infrastructure at this stage, and obviously, there is the opportunity for that infrastructure to develop. And so, it's unfortunate that some of the policies and requirements don't go in tandem with that development or meet us where we're often at.
That I think is a conversation that Africa as a region needs to probably take up at a multilateral level, one feels. And obviously within Africa, there are different fiscal and monetary policy challenges and responses at the sovereign level. So given that, can you provide some example of how African central banks are navigating this challenge of kind of high inflation while also attempting to stimulate economic growth and being mindful of going kind of pole, slowly, as you said earlier, especially in light of the policy-driven currency devaluations in countries like Egypt and Nigeria, where, clearly we see some kind of reform taking place under the surface as well. It's a very difficult balancing act.
It is indeed. So I think, the central banks are largely responsible for price stability, which has been tough in this environment and coming out of the pandemic. And it's also been at the expense of growth at late. So I think a lot of central banks have generally taken the stance that fighting inflation will be positive for growth over the medium term. So getting that macroeconomic stability, helping create a more predictable economic environment and one that encourages investment, savings, and long-term planning. I would say for growth, we probably also need to lean on governments more and them targeting spending to productive sectors of the economy. So to stimulate growth, these countries are also implementing various fiscal measures. Obviously, these aren't short-term measures, but this is increasing public spending in key sectors, implementing structural reforms to also improve the business environment. I think we also have, some of these countries outlaying some of their plans in their national development plan or their medium-term fiscal frameworks. And we've seen successive and successful NDPs in countries like Ethiopia and Ivory Coast. So these have kept economic growth elevated. Many countries are also trying to increase government revenue. So these revenues obviously can be used to fund some of the growth stimulating initiatives, so your infrastructure development and some of the social programs. So I think there's still robust economic activity in many of our economies. We're looking at about 5% growth and above for quite a few economies this year, but that's largely concentrated in the East Africa region. But your Ivory Coast and Senegal in the West are also looking good for growth prospects.
I just want to stay on the monetary policy responses that we've seen so far, coupled with the fiscal. And really, when I chat to South African CEOs often who've headed into Africa, they've been burnt from a foreign exchange perspective. That's been one of their big challenges, is either repatriating funds or dealing with currency devaluations and hyperinflation. How can African countries improve their FX stability? Because I think that would go some way to attracting more stable and consistent investments.
Yes, so I think you've mentioned the devaluations of Egypt and Nigeria earlier. So, I mean, there's been those struggles in those economies. Many of it, as you said, it's been about FX liquidity. And we know that adjusting the FX rate is a way to release pressure when you look at it from a balance of payments perspective. So, releasing the pressure valve, you would say. Ideally, when you look at currency regimes, something like a free float or one that resembles a free float is generally good. Or if there's a managed currency regime, it shouldn't lead to things like dislocations and an FX backlog. Often we find sometimes the management of the currencies is too intense and we do get those dislocations and backlogs of FX demand. So ultimately you want price discovery and you want to get rid of pent-up FX demand. You want to create confidence in the FX regime and you want investors to know that there's convertibility. So being able to enter and exit a country, repatriate profits, and obviously these are all essential for investors. So I suppose, it's about stability, but also predictability. Both investors and authorities should be aware of the FX regime and implications of that regime. Also things like seasonal factors that impact supply and demand. So I think, authorities also need to build a decent FX reserve buffer to account for shocks, but ultimately, in most cases, allowing the currency to find a clearing level and limit interventions to cases where it's more about smoothing the currency velocity. Yeah.
When you say that, it seems to me like Nigerian President Bola Tinubu, who gained admirers for the speed with which he started implementing his economic reforms. Clearly, there have been growing pains as the economy adapts to this, but it seems to me like he's trying to do that. He's trying to provide greater predictability and certainty. And obviously, when you've had a market that has been so strictly controlled, now becoming so deeply liberalized overnight almost, you do get these growing pains, and it's a question of, that settling down over time. Let's come back to the main insights from the report itself. When you look at it, what are the key differences in the economic performances and the potential metrics compared to the previous editions? Were there any unexpected trends or shifts in the rankings of certain countries that stood out to you in this year's report?
I think it's a little difficult to compare the rankings as such, just because we've changed the methodology a little bit. I know there's been a lot of surprised people that have wondered why Seychelles and Mauritius is at the top of the rankings. But I think, to speak to that, again, it's about the methodology that we've used, which is a lot more robust. And I think when you look at countries like Seychelles and Mauritius, even though they don't score too high on things like economic performance and potential, they score relatively well on social and human development. Seychelles is number one for things like personal freedom. And then you have economic stability and the investment climate, where we consider economic freedom, corruption, political stability as well. So those are key pillars where Mauritius and Seychelles does relatively well. I think for Mauritius as well, it ranks number one in innovation. So I think that's what's carried those to the top two. And they've been quite consistent on those three pillars.
I didn't find that surprising at all. I think Mauritius has been one of the go-to destinations to invest for some time now, and it's been deliberate. From a policy perspective, they've created a favorable investment environment through certainty, through favorable tax treatment, through that, you mentioned, that high development of human capital. And, we've just had the Olympics wrap up, and it shows that the top 10, 11 countries are all, countries that embrace capitalism, democracy, and human development. in the main. And, Africa could learn a lot of lessons from the Olympics as well. We have that youth population, and the demographic dividend is often spoken about, though. So when we look at how we build on this as the disparate countries across the broad continent of Africa, what specific policy should be prioritized to ensure that Africa's young population becomes a driving force for economic growth rather than a source of instability?
I think it's easy to say investing in education and creating employment, but getting it done remains a challenge. And also, it's also about the right education is also important with practical skills. Even things like agri skills, I think, should be molded into an education system. We've talked about promoting entrepreneurship, which I think can also in turn attract investment if you end up with enabling business environment. There are also things that we've discussed about having the youth better access resources. So whether it's from, government policies or even from the private sector, like accessing credit. And there's the inclusiveness. So, contributions from the youth and youth-led initiatives with empowering partnerships. So I think there's a lot that can be done to help harness the potential of Africa's youth, but it's not always easy to implement.
It's down to execution again and political leadership. And while we've seen some encouragement, far too often, if you just look at the mineral sector, for example, that stereotype of foreigners in Africa, of neo-colonial exploiters interested only in the continent's natural resources, not its people, who are ready to bribe local bigwigs in shady deals that do nothing for ordinary Africans, that stereotype sadly still persists, and one sees examples of it, especially in managing Africa's mineral wealth. I think here of the fact that we finally getting the massive Samandu iron ore project off the ground. It's been mired in corruption controversy for the last 2 decades. And we, Dutch disease, a very famous, economic theory of mineral wealth actually being more of an albatross around a country's neck than anything else. How do we turn that around, given Africa's substantial reserves of critical minerals and the just energy transition and the new push for green metals in particular? What are the strategies that you'd like to see employed to avoid the resource curse and promote sustainable development?
Again, I would say this is not an easy task, but it's always about managing the resource wealth effectively and using some of that to invest in the people and infrastructure. So looking at skills and investments basically for the future. I think also, there's been local ownership of some resources that could prove positive and help reduce the resource curse. So local content policies, resource-driven industrialization policies, and putting policies in place to ensure that the exploitation of some of these natural resources doesn't harm the environment. I think what we've also been seeing is that there's more and more African countries on the continent adopting the so-called best practice policies of saving funds from this mineral wealth. So you are seeing the formation of sovereign wealth funds, oil stabilization funds, etc. So these strategies are there in place to avoid the resource curse.
Similar to Norway's model. Just moving on to funding and investment gaps, and obviously funding Africa's infrastructure, as we're trying to do here in South Africa, becomes a key because these network industries of roads, power, water, ports, infrastructure that enables economic growth is really foundational. You need to get that right to unlock the next leg of growth. There's an estimated annual infrastructure investment gap of some $100 billion US. What are the innovative financing mechanisms that could be explored to attract more investment into funding critical infrastructure in Africa?
So I think in terms of funding, we've seen a few things. Initially, there's been a lot of concessional financing, so the likes of the IMF, the World Bank, African Development Bank on certain projects. But then we've also had Eurobonds, so the Eurobond market being a place where Africa would issue, and a lot of those funds being used to invest in infrastructure. And now we also have things like your impact investments. So I think these have started to take off at late. and these will benefit some of the countries. So we've seen, for instance, the likes of Gabon doing a blue bond as well, so using some of those funds for infrastructure development. And I think that more and more countries are using more innovative ways to finance some of the infrastructure. So I think the impact investing obviously offers financial returns, but then also addresses some of the critical issues such as renewable energy, things like healthcare, education, and even economic empowerment to some degree.
And obviously, African countries can learn from the success factors of the likes of a Seychelles and a Mauritius, and to a lesser extent, South Africa and those that rank in the top 5 as well, to encourage greater international appetite for investment in local infrastructure projects. As a bank, are you seeing investment appetite improve to invest in African infrastructure?
We have been seeing a lot more activity in the Africa infrastructure space, but as you said, the gaps are quite evident as well. So there's been a lot of projects that are underway in Africa, and these are also expected to significantly transform the economic landscape. You've got projects on the energy side of things, but also transport projects, and it's quite vast. So there is definitely a flurry of activity. But perhaps to my earlier point about cautioning on how fast some of these developments take place, I think slow and steady is perhaps the easier way to do, to identify some of the critical infrastructure projects first versus everything else.
Well, slow and steady is, as we know, how the tortoise beat the hare at the end of the day. Thank you very much, Sam Singh-Jami, strategic analyst with RMB, for taking us through the 2024 Where to Invest in Africa report. It's been a real pleasure sharing those deep insights here on the Monocle Banking Podcast. Take care. You've been listening to the Monocle Banking Podcast. Be sure to subscribe. Available on all good podcast platforms. For me, Michael Avery, I'm signing off, and be sure to tune in next week. I think we've got a surprise from Cappy Tech up our sleeves.